Bitcoin is once again testing the patience of investors. Despite steady institutional buying, strong long-term narratives, and continued global attention, Bitcoin's price has remained stuck in a relatively tight range. For weeks, the world's largest cryptocurrency has been trading just below the $71,000 level, unable to break higher, yet also refusing to collapse. This unusual price behavior has sparked an important question across the crypto market. Why is Bitcoin moving sideways even as institutions continue to buy? To understand what is happening, we need to look beyond simple price charts and examine market sentiment, institutional behavior, mining economics, regulatory uncertainty, and broader macro conditions shaping Bitcoin's current phase. Bitcoin trades below $71,000 as momentum fades. At the time of this analysis, Bitcoin is trading just under the $71,000 mark, showing signs of exhaustion after recovering from earlier declines. While prices are no longer falling sharply, upward momentum has also weakened significantly. According to CNBC senior crypto reporter Mackenzie Sigalos, the current price action reflects a market that has moved out of the excitement phase and into a period of cautious evaluation. Unlike previous rallies fueled by fear of missing out, leverage, and retail speculation, today's Bitcoin market appears calmer, more controlled, and far more selective. Buyers are present, but they are not aggressive. Sellers exist, but they are not panicking. This balance is creating what analysts describe as a consolidation phase, where prices move sideways as investors wait for clarity. A shift in market psychology. One of the biggest changes in Bitcoin's behavior is psychological. Earlier bull runs were driven by emotional momentum. Investors chased price increases, leveraged positions expanded rapidly, and market optimism fed on itself. Today, the tone is very different. Investors are no longer rushing in blindly. Instead, decisions are increasingly based on risk management, capital allocation, and long-term positioning. This has resulted in lower volatility and slower price movement. Rather than reacting to headlines or social media trends, both institutional and professional investors are waiting for stronger signals before committing significant capital. This wait-and-watch approach is one of the main reasons Bitcoin's price is moving sideways. Lack of fresh catalysts is pressuring Bitcoin. Another major factor limiting Bitcoin's upside is the absence of new positive catalysts. In recent months, optimism had grown around potential regulatory progress in the United States, particularly surrounding the Clarity Act, which many investors hoped would provide clearer guidelines for crypto markets. However, progress on this legislation has stalled. With no movement in Congress and no clear timeline for regulatory clarity, the excitement surrounding potential policy breakthroughs has faded. Investors who were positioning early in anticipation of favorable regulation have stepped back, choosing caution instead. Without regulatory momentum, Bitcoin lacks the spark needed to push decisively higher. Political optimism has also cooled. Earlier confidence tied to President Trump's return to the political spotlight also appears to be fading. While some investors initially viewed Trump's stance as potentially favorable toward crypto markets, broader political uncertainty and mixed economic signals have reduced enthusiasm. At the same time, traditional financial markets have shown signs of stress. Equity markets have experienced volatility, bond yields remain unpredictable, and macroeconomic uncertainty continues to influence global investment decisions. As a result, many large funds are reducing exposure to risk assets, including cryptocurrencies, even if they remain bullish long-term. This cautious approach has weighed on Bitcoin's short-term performance. The digital gold debate resurfaces. Bitcoin's role as digital gold is once again being debated. Critics argue that Bitcoin has not consistently performed as a safe haven during periods of economic stress. They point to moments when Bitcoin has declined alongside equities, questioning whether it truly acts as a hedge. Supporters counter this argument by emphasizing Bitcoin's long-term fundamentals. They argue that traditional currencies continue to lose purchasing power due to inflation, rising debt, and monetary expansion. In contrast, Bitcoin's fixed supply and decentralized nature make it attractive as a long-term store of value. This ongoing debate adds to uncertainty, keeping investors cautious and limiting aggressive price action. Why $60,000 has become a critical support level. Despite recent weakness, Bitcoin has repeatedly found strong buying interest near $60,000. According to Mackenzie Sigalos, this price zone aligns closely with the average cost of mining Bitcoin. Mining costs play a crucial role in Bitcoin's price structure. If Bitcoin falls below the cost required to mine it profitably, many mining operations would be forced to shut down or reduce activity. This has two important effects. First, miners become less willing to sell Bitcoin at a loss, reducing selling pressure. Second, reduced mining activity can tighten supply, helping stabilize prices. Because of this dynamic, the $60,000 level has effectively become a price floor, similar to production costs in traditional commodities like gold or oil. Each time Bitcoin approaches this level, buyers step in, preventing deeper declines and pushing prices back towards the $70,000 range. Mining economics are shaping the market. Bitcoin's mining economics are playing a more visible role than ever before. With energy costs rising globally and mining difficulty remaining high, only efficient operations can remain profitable. This creates a natural supply constraint. Unlike earlier cycles where miners aggressively sold into rallies, many new miners today are better capitalized and more strategic. They are holding Bitcoin rather than dumping it, especially near critical support levels. This behavior adds stability to the market and contributes to Bitcoin's sideways movement rather than sharp declines. Institutions are quietly buying the dips. One of the most important differences between this cycle and previous ones is the role of institutions. Retail traders are no longer the dominant force in the market. Many individual investors have shifted their attention to alternative platforms, short-term speculation, or prediction markets. In contrast, institutional investors are steadily accumulating Bitcoin, particularly through spot Bitcoin ETFs. Recently, spot Bitcoin ETFs recorded approximately $300 million in net inflows in a single day, signaling that institutional demand remains strong, even during periods of uncertainty. ETF providers report continued interest from long-term investors who view Bitcoin as a strategic asset rather than a short-term trade. This steady demand is preventing sharp sell-offs, even as overall market sentiment cools. Why institutional buying isn't pushing prices higher? Despite these inflows, Bitcoin's price has not surged. The reason is simple. Institutions buy differently than retail traders. They accumulate gradually, spread purchases over time, and avoid chasing price spikes. Their goal is exposure, not momentum. As a result, institutional buying provides support, not explosive upside. This explains why Bitcoin remains stable but lacks the volatility seen in past bull markets. Reduced leverage is lowering volatility. Another important factor is reduced leverage across crypto markets. After multiple liquidation events over the past year, many traders have become more cautious with leverage. Funding rates have normalized and speculative excess has declined. This reduction in leverage means fewer forced liquidations, fewer panic moves, and slower price swings. While this creates a healthier market structure, it also contributes to sideways price action. What happens if selling pressure returns? If selling pressure increases again, analysts expect Bitcoin to retest the $60,000 support zone. Based on current market behavior, buyers are likely to step in at that level, particularly institutional investors and miners defending profitability. A sustained break below $60,000 would require a major negative catalyst, such as regulatory crackdowns, macroeconomic shocks, or severe risk-off sentiment in global markets. At present, none of these appear imminent. Why Bitcoin could stay range-bound? On the upside, Bitcoin faces resistance near $71,000.
Without fresh regulatory news, macro improvements, or major adoption announcements, breaking above this level may remain difficult. As a result, analysts believe Bitcoin could continue trading within a broad $60,000 to $71,000 range in the near term. This type of consolidation is common in mature markets and often precedes larger moves. Consolidation is not weakness. It's important to understand that sideways movement does not mean Bitcoin is failing. In fact, many long-term investors view consolidation as a sign of strength. Bitcoin is being supported by institutional demand, defended by mining economics, and stabilized by reduced speculation. Rather than collapsing or spiking unpredictably, the market is building a foundation. Bitcoin waits for its next catalyst. Bitcoin's current sideways movement reflects a market in transition.